Thank you all so much for being here today. I believe this is one of the final, if not the final panel at today's Vision 2020 conference. Thank you to the Washington Center for Equitable Growth for having us, and obviously thank you so much to our panelists for joining today. As the announcer just said, we have with us Karen Dynan, an economist at Harvard University and former Assistant Secretary for Economic Policy at the Treasury Department under President Obama. We also have Claudia Sahm, who is currently the head of consumer research at the Federal Reserve and will soon be the director of macroeconomic policy right here at the Center for Equitable Growth. So congratulations.
Thank you.
And unfortunately, just one programming note, Mercer from the University of California, Irvine, unfortunately was unable to join us, but we will have a robust discussion nonetheless. So I think that you've heard earlier today about sort of the root causes of income inequality, some bold ideas for addressing it and closing the income inequality gap. Here we're going to talk about the linkage between income inequality and the macroeconomy. So Karen, I was hoping that you could start us off by just sort of laying out the landscape for us and sort of describing the channels through which income inequality could potentially damage the broader economy.
Sure. Thank you, Ylan. It's a pleasure to be here with you and Claudia. And congratulations to Claudia and to Equitable Growth for getting Claudia. So glad that you're doing a panel on this topic because I think it's a really important topic and needs more focus. Income inequality in the macroeconomy. So a few channels there. First one I want to flag is just the very direct effect that kind of decades of limited income growth in the middle and lower part of the distribution has left kind of just a huge swath of households struggling to save. And I know Claudia is going to talk about those patterns, but saving is such an important vehicle for economic mobility in just this very direct sense, because households that don't have saving are going to find it much more difficult to fund investment in higher education, to start a business, to move to some place to take a new job. All of those things not only hurt those households, but they hurt the productive capacity of our economy. So, very obviously a less skilled workforce, because some people can't get a college education, is going to kind of lower our potential output. But, things like starting a business, being able to move to take a new job, those are all centrally related to economic dynamism, which we know has fallen over the years and has been a problem for growth. Okay, so that's one channel. Next channel is something that, I probably wouldn't have mentioned if you'd asked me this question 10 years ago. It's only something economists really started to think about kind of after the financial crisis and kind of with the economy the global economy really taking so long to recover. And that is sort of growing income inequality has basically kind of depressed aggregate demand. With the logic just being that we know, and it just seems intuitive to people, that households who are higher in the income distribution, they save more, they consume less. So as they get kind of a greater share of income, they're saving more. That kind of has this direct effect on aggregate demand, but kind of all those funds are kind of then swirling around in the economy, kind of, creating kind of more demands for investment opportunities. And one effect that has been to kind of bring down what we would call the equilibrium or neutral rate of real interest. Couple of important things to flag there. And one is can make the economy more prone to credit cycles, because you've got investors looking for opportunities. They're on the supply side, they're going to be kind of more interested in funding riskier investments. And then on the demand side, of course, you've got households, because of the reasons I just described, kind of looking to take on credit because they don't have the income to achieve economic mobility. So that's one sense in which those lower interest rates are a problem for the macroeconomy. Kind of the other sense, and I think Claudia will probably talk about this as well, is that these lower interest rates are, of course, at the heart of this kind of zero lower bound problem we have with monetary policy, whereby we just don't, if we go into a downturn, we don't have as much space as we would have traditionally to kind of fight that recession with monetary policy.
So, Karen, you mentioned the sort of root problem of inability to save as a real issue in households being able to accumulate and form wealth. Claudia, you spent a lot of time looking at sort of the thin buffer that many households have here. Can you tell us how healthy is the American household, and what does that mean for their ability to weather a recession?
Great, thank you. Thank you, all of you. So I just want to start, since Karen thinks I'm going to talk about monetary policy in a little bit, these are my views and not those of the Federal Reserve, and I get to...
Is the Fed going to cut rates again this year?
Yeah, so I get to say that disclaimer for 3 more weeks, so okay. So to answer your question, just broad brush in terms of the amount of financial fragility that we see among American households now, and frankly we've seen for decades and decades, there is no recession that we are ready for, especially given the policies that we have in place. I mean, I had the opportunity, so Equitable Growth and the Hamilton Project put together a volume, recession ready, and we talked about strengthening automatic stabilizers. So when you think of, there are opportunities, there are policies that could help buffer for households. There could be a stronger safety net in general that would help not just in a recession, but this building resources over time. So I had worked 10 years on the macro staff forecast at the board, so I really do understand how we look at GDP from quarter to quarter. And worked on consumer spending, so with households. In the last 2 years, I've been a manager for a group in Consumer and Community Affairs that runs the Survey of Household Economics and Decision Making. So some of you may have heard about the $400 question. My boss, Dave Buchholz, says at this point I'm completely obsessed with that question and making sure that it's understood. But then I'll talk a little bit about that question, but I think in essence what I said before, there are many households that have very thin financial buffers. And really the numbers are shocking. I mean, and I think this was when the survey began in 2013, they had a question that was, how would you handle a $400 expense, emergency expense? And at that time, half of US adults in this survey, which is representative, told us that they would borrow, sell something, or simply could not pay a $400 expense. That got a lot of attention. That's why you all know about this question. Over time, it has improved. So now we're at about 40% of households. That's still a lot, right? And trying to understand this and unpack it, and it really is like a decision making, what would you do? It doesn't mean these households don't have $400. Some of them don't. Our colleagues who work on the survey of consumer finances at the board, who actually have balance sheet data, they estimate in 2016 that a quarter of US households did not have $400 in easily accessible assets. So I mean, I just can't imagine that reality, and there's plenty of research, both ethnographic and in our survey, that shows that a $400 emergency expense, those happen, and they happen often, and they're extremely disruptive. And so our survey covers various dimensions of economic well-being, and for many Americans now, at this point in the expansion, things look pretty good, but there are definitely parts of the population, the communities that just are in a bad place and very structurally have been for a long time. So I think we'll probably talk more about it, but there's definitely disparities that we see.
And one thing I'd like to just unpack a little bit more that you guys have both mentioned is that, I mean, obviously the idea that a family doesn't have $400 in their bank account for an emergency is troubling for that family, but how does that translate into a broader economic hit? So Karen, you talked a little bit about the marginal propensity to consume versus the propensity to save and how that could impact aggregate demand. Can you guys talk a little bit more about why this isn't just a micro problem? Why is this a macro problem?
Sure. I mean, I'll start and let Claudia build on it. I mean, it's these thin financial buffers, what they basically translate into is kind of fewer or thinner shock absorbers in our economy. So, it makes it difficult for a household to recover from a shock, but if you have kind of a shock to the economy as a whole, and you have kind of lots of households who are having income disruptions, if all of them are having more trouble climbing out of this hole, it's just going to make kind of downturns, kind of longer recoveries, more prolonged till you get back to full employment. So in fact, I think in the aftermath of the financial crisis, we did go through several years where we felt like people were talking about, is it going to be the traditional V-shaped recovery? Is it going to be a U-shape? Is it going to be like a W with like kind of bouncing up and then bouncing back? But I think a lot of what was behind that was this idea that kind of we weren't prepared to kind of suffer any kind of little setback, just given the state of the economy.
Yeah, no, and so I fully agree with all that. And I will say, so my first year forecasting at the board, I was expert on consumer spending, was 2008. So that was the year that I learned how to forecast. That year when all of the models broke, everything that we had said for years,
and I learned how to forecast.
Yeah, and I wasn't there, so I couldn't, but I had to figure out what was going on, and I just kept my head above water. And we have an amazing group of colleagues. So I've thought a lot, and my research very much shifted focus to thinking about how households respond to fiscal stimulus. So while the Federal Reserve does not comment on fiscal stimulus, we do need to understand it, right? Because monetary policy works in an economy where there's other types of policies and shocks. And so I had the opportunity to do quite a bit of research, and there were many different ways that various administrations tried to support households during the recession, in the recovery. And so I learned a lot about, read the research, did research. It actually, 2008 was very hard. There was a lot of suffering that was going on. And I think I'll come back to the point about why recessions are different with the fragility. And I will say, for me personally, in my professional, as a forecaster, it was the recovery that was heartbreaking. Because we kept saying, it's going to come. I had a senior colleague who I'd come in over and over again, and I said, I'm looking at consumers, this doesn't look good. And he's like, Claudia, the macroeconomy always recovers. And I'm like, look, I haven't been here when I've seen this happen, but I'll, not gonna take your word for it. Anyways, but it did recover. We are at a place in the expansion where while there are still many structural problems in the economy, we have by and large, we're in a much better place than we were in 2012 or any time there. So to the question about why, financial buffers are always a problem, and Karen talked about this before, there's just not this opportunity to invest. You can't send your kids to college, you can't start a business, or it's just very hard because you're always trying to deal with these $400, of savings. In a recession, so by definition, that is a big shock to the economy. So when the unemployment rate rises to 10%, you have a substantial number of families, either someone in the family losing their job, and that isn't a $400 shock. That's a big shock. And so what happens is you have a much larger swath of a lot of people have financial buffers that are thin, but then all of a sudden, a lot of people get hit at once, and then that can be, consumer spending is 70% of the US economy, so that can really start to have bad implications, not just for those households, and then there's a lot more of them, but then for the economy as a whole. And then we really are challenged with the tools to get that under control, to stop it and not have what happened in the Great Recession, or frankly, any recession.
It seems that where we are now in the economic cycle, obviously we are far off the depths of 2008, 2009, up to through 2012. Right now we're in a cycle where the consumer is leading economic growth. The consumer is the pillar of the economy right now. Does that present any dangers as we think about the potential for the next recession, that so much of the strength that we see today is on the backs of the consumer?
That's entirely correct. And when I'm wearing my hat as a forecaster, because I like Claudia, have been trained as a forecaster. In fact, one of the things I have in common with Claudia is we had the same job as she did many years before her. Our economy as a whole is looking pretty good. There's some significant risks from abroad, but if I had to kind of name the kind of one thing I'm concerned about internally, is the fact that it is a consumer-dominated expansion right now. Investment has pretty much stalled over the last year. I mean, people are investing, but there's been no growth in investment. That's a problem. I mean, it's a problem. For what you mentioned. I mean, it does. Generally, you want to see kind of growth spread across a lot of sectors because one sector could be hit by, say, a shock to their income from higher tariffs kicking in, or something like that. It also has very kind of concerning consequences for the longer run because if firms aren't investing, then we're not kind of growing the productive capacity of our economy.
Claudia, any thoughts?
Yeah, so I'd have to say, I mean, I wouldn't be a macro forecaster. I'd have to turn in my badge if I weren't eternally pessimistic about what could happen in the economy. That's our job, to think about downside risks. You all can celebrate the happy, but that's not what we're here for. So I guess, I don't take this too, react too badly to this. So in 2005, the consumer sector looked great in the United States.
That's a good point.
I mean, consumer spending was good. I do not, there were imbalances in other parts of the economy. So household leverage ratios look much better now. I mean, there's some sad facts to that. People have been, they lost their homes. They haven't been able to have access to mortgages. But if you look, if you look at consumption and consumer spending growth, it was good in 2005. That should not be something to take comfort in. There's other things I'd look at in the economy that would say, I'd maybe worry a little bit more about the business sector than the consumer sector. But the other point I wanted to make, and I think this is one that Equitable Growth and a lot of their research and other groups, the Fed as well, there's a lot under the hood of those aggregate numbers. So at the Federal Reserve, they've started a new project to look at the distribution of wealth across the economy and look at it over time. So this is the distributional financial accounts, and they look at it in many dimensions. And this is not surprising to any of you in the room. Wealth inequality has increased a lot over the last 3 decades. And so when you look at consumer, and Karen talked about, the propensity to consume is different, but the gains, where that spending is, it's not equally distributed. Not everyone has seen those gains. So when you look at those aggregate GDP numbers, not everybody is experiencing that. It is very clear in the data. And one of these things, when we bring the data, and there's been support for a lot of these initiatives, we can actually put some numbers to it. We kind of have an intuition about what's going on, but we can unpack it, we can know how big it is, we can know where it's showing up. And then that's, then we have a lot of work to do to figure out why and what next.
Yeah, and if I can just build on what Claudia was saying for a second, I mean, I think one reason, I see this all the time in kind of media coverage, people tell us to don't worry, be happy, is that we see a high aggregate saving rate right now. Mm-hmm. And that means the economy as a whole is saving a bunch. But we don't actually know who's saving. I suspect, I expect it's wealthy people. I suspect it may be boomers who are worried about their retirement. But I suspect maybe some millennials saving to buy homes, but kind of what Claudia's numbers, these distributional financial accounts are telling us is there's still kind of a broad swath of Americans who are not saving despite this kind of pretty high aggregate saving rate.
Right, and Claudia, you've done some work around looking at sort of household finances broken down by race, gender, et cetera. What do those numbers tell you?
There are a lot of differences across the economic well-being, the lived experience across households, families in the United States. Again, not a surprise to anyone. One of the things in our report, see, I brought props. My son was not impressed with these props.
We're impressed with these props.
Yes, so every year we put out a report on household well-being. So this goes with our survey. And I've gotten to work overseeing this report for the past 2 years, and it's hard. Every single chapter, we look at a lot of different dimensions of economic well-being. The Shed is very into just asking people, how are you doing? And without putting a lot of structure on it. And then we take objective measures, or the $400 question, how would you deal in financial situations? So we have each chapter is a different aspect. Every single chapter, there's such clear differences by race, ethnicity, education, parts of the country, gender in some cases. It comes up over and over. and they're big. And one of the things, at the Fed, we talk a lot about the expansion. This is great. So happy inflation is under control. So you want to start thinking, well, as we push on in this expansion, we get another year, the unemployment rate goes down, it stays down. Are we going to start closing these gaps? Like, these are structural gaps, but like, we haven't run the economy this hot since the 1960s. That was a good time. I mean, the 50s and 60s were a good time for, raising all boats. There were very different policies in place, as we heard in the last panel. And we looked for it. I mean, I so wanted to find something that would look like gaps closing. And we have some colleagues who've looked at much richer employment data, and and kind of, which again shows these disparities, but maybe there's this, like, if you squint hard, you see something. So not in the shed. Like, these disparities are there. They aren't getting worse. And frankly, over the recovery, and the shed just starts in 2013, so we can't see, on average, all those groups are trending up. So you see, it's not that, in that case, when you look at race, ethnicity, it's not like these gaps are going apart. We don't have a long time series. Those are like long trends. But there's no sign, and they're big.
Yeah, so I worked on student debt when I was at the Treasury Department. So kind of when Claudia was over at the Fed kind of crying about the recovery, I was like over at the Treasury crying about student loans. So I do a lot of kind of thinking about, I'm still really concerned about the situation. I guess a couple of points. First one being, basically the idea of programs that kind of increase access to higher education, that's a really good idea. A college education remains kind of the probably best ticket to the middle class, okay, or at least kind of most college educations remain that. If you kind of look at the data and you look at children that were born to kind of the bottom of the income distribution, you can see that if they don't get a college education, you can see nearly half of them just remain at the bottom of the income distribution. Very few of them, 15% or something, get up to the top 40% of the income distribution. Getting a college education changes everything for those kids. I mean, the numbers that stay at the bottom are small. They're more like kind of 15%, and the numbers that get up to the top two quintiles, are between 40 and 50%. So for most people, kind of that college education is really important. Okay, that said, there's just too many people who are struggling to pay their student loans. The numbers they're awful. I mean, we know we had this huge run up in debt. If you just look at student loan delinquency rates, you see numbers like between 15 and 20%. That sounds bad. Okay, that doesn't begin to tell the right story. You need to parse the data more finely. If you look at that population and you kind of take out the portion of the borrowers who aren't supposed to be paying their loan because they're still in school, and then you look at the rest, some are delinquent, some are troubled. They're not technically delinquent because they're in deferral or in forbearance, okay? If you kind of take that group, the group that's in delinquency, deferral, or forbearance, and compare that to the group that's supposed to be paying their loans off, you're getting a number more like 42%. Okay, and that's not even all, because the government has programs to kind of alleviate the hardship that basically allow you to kind of pay less than you would under the standard arrangement, which is good for the borrower in some ways. But what you're doing is kind of just lengthening the period until they pay off the loans. They're not kind of making much progress. So you add those people in, you get like something like half of student loan borrowers are not kind of making any progress paying off their debt. Is that obviously it's bad for the individual. Is it a macro issue? Yes, it's a macro issue. The literature has some trouble disentangling this all because it's hard to kind of separate the effect of the loan from the fact that you got a college education, which is good, from the loan. But I think it's just kind of clear, based on kind of anecdotes, based on intuition, that it is holding back kind of the younger, kind of the millennials. I mean, we can see they have lower rates of kind of moving out and becoming their own household, high rates of living with their parents, low rates of home ownership. I think it's going to be a number of years before we can kind of disentangle this and really understand all the harm that's been caused by the ramp in student loans, but I think we will eventually come to see this as a very pernicious thing. I guess the last point I just want to make is that it's not a general problem with the program. It's some very specific problems with the program. I mean, the fact that large numbers of people are struggling reflects the fact that large numbers of people didn't get an education that paid off. Okay, and that comes from the program not having enough accountability in there. There's not enough kind of safeguards in there to make sure that the schools are delivering value to the students. And in fact, you can kind of identify kind of a whole kind of group of schools that basically charge, most of them are in the for-profit sector, they charged high tuitions, without kind of graduating. I mean, a lot of cases they didn't graduate students, but those who graduated, a lot of them did not come out kind of earning the kind of income you would expect, given how much they put into it.
So Claudia, if you're
Could I follow up
on that? Yeah,
a
sure.
little bit on this? So one of the other things that we ask in the survey, this is a little this relates to student loans, but it's really about the benefits of education. So we ask adults who have attended some college, and this includes professional training, trade schools. We ask them, do you think the benefits of your education outweigh the costs? So in financial benefits, financial costs. As Karen had said before, on average, education pays off. Right? It gets you to a better job, higher wages. Not for everybody, though. I mean, that's what's really important at looking at household level individual data, because it can get masked in the trends. The trends are important. But we see there are clear patterns. And so I do want to emphasize the point that there are institutions that are different. Again, when, it's an on average, but the for-profit private schools have notably worse outcomes. And that's an area where we actually see, on average, individuals who went to these schools telling us the costs outweigh the benefits. Like in that, or just there was no benefit at all. I mean, but you got debt because of it. So, I mean, any of that is very problematic, especially if it shows up on average. There's always going to be people that college didn't turn out the way they expected. That's a problem. The other thing is, again, this is not uniform across individuals. There again, you see the racial, ethnic, you see the disparities that show up other places. And the other thing you see, and this is actually really problematic for growing the productive capacity of the economy, let alone investing in your families and future, first generation students they're more likely to go to for-profit private schools, and they are less likely to walk out of college saying on net, it was a benefit. And that's a real problem. That's where our opportunity to grow the economy is, with the people who their parents didn't have that opportunity. So but education's good, and it's this really big balancing act of but as with almost everything, the details matter, right? And if you don't specify the details, if you don't put oversight in place, and it's varied over time how much oversight there is, and there's research that shows oversight matters, rules matter, but I think that's the piece, that it's all this together. You've got student loans, the completion rates are too low, you have programs that really don't have value added, so you got to kind of deal with those separately.
Yeah, I should have flagged that with the trends. The racial disparities in student loans, they're awful. I think they're clearly tied to the wealth gap, and I know you've been talking about that today, but it just, to me, looks like a self-reinforcing cycle.
So if you guys are policymakers, and Claudia, I want to kick this to you because you have some interesting ideas on this. You're faced with another recession. You're looking at households with thin financial buffers who maybe have not had the ability to invest in themselves, saddled with debt. What is the way to help them? Is there a uniform policy that can be best directed at these families and at these households?
So in terms of recessions and how to support these families that have thin buffers, I mean, frankly, it's get ready now. So I think this is the thing. A lot of times with fiscal policy, now there are many automatic stabilizers in place, like unemployment insurance, extensions. The unemployment rate takes some time to rise, right? So it'll get there, and that's very important to have targeted support for families. What I had talked about in the policy chapter I wrote is we ought to have payments to households that go out quickly, right? And so this was kind of one of the things I had developed was a recession indicator to say, we're in a recession, get those checks out. And I think, and that's an opportunity for the government, and they've done this in the past. Like we have experience with payments or different like tax cuts and different things, but they've always had to go through Congress. They have to get approval. The details have got to get worked out exactly what to do it. There's no reason why we couldn't sit down right now and write up a plan. And have those policies, if not already approved in kind of an automatic way, at least have them figured out.
And these would be direct payments to struggling individuals.
Well, in my proposal, and this again is kind of looking at the research, other people could disagree, what I had proposed is just cut a check to everybody. Like get it out the door. I think there are these differences in spending propensities. I think, trying to put on my lopsided little political economy hat, I think they're very transparent. Monetary policy is not transparent. Like it's really hard to explain what it's doing. It's very good, it's very important. It also works with a lag. People can understand, like the government's got my back. They're giving me $1,000 and they give it to everybody. It's not like the mortgage forgiveness where this was like, well, I picked a good mortgage and it goes out to everybody and people know it. And there's anyway, so that was part of my proposal, but that's like a piece and this volume talked about. There are all kinds of stabilizers, food stamps, unemployment insurance, payments to there's so much we could do and there's so much we could do now to get ready. That's for a recession. I don't want to just be all about business cycle stabilization, though that's been my life for 12 years. Because there are a lot of policies we can just think about in terms of safety nets that could allow households at any point in time to save, build wealth. But that's that isn't something I've spent time on.
But Karen, you've also kind of pointed out that your experience from the previous recession was that maybe some of the standard tools that we would use in a recovery didn't work the way that you thought they would because people's experience was different, and because the earnings and sort of the damage that individuals' households were facing was so varied.
Yeah, so that's right. I mean, I think so I think the world is changing all the time. Glad that Equitable Growth is sponsoring research to try to understand more about heterogeneity across households, meaning differences across households that make the effect kind of different over time. But for example, when we talk about monetary policy, kind of there are the traditional channels through which we think it operates. But to the extent you're cutting rates and you think people are going to refinance their loans and kind of then have more cash in their pocket to spend, well, if a bunch of people are underwater, it doesn't work. If you are cutting rates and you think, oh, people are just going to go out and get more car loans, well, people already have tons of student loans and the car dealer is not going to give them a loan, that's not going to work either. So you got to keep kind of policy needs to kind of be nimble in this regard and keep thinking these things through.
How important is the automatic part in automatic stabilizer? Do you have something on the monetary policy front? Or?
Yeah, so
I was going to come back to
automatic,
that.
but I do want to add on monetary policy, and again, disclaimer. No, because I think the other piece, and again, there's a lot of very interesting research trying to figure out this unconventional monetary policy. So, I mean, they lowered the federal funds rate to 0, and that was pretty early in the recession. And then it was like, okay, what else can we do? Asset purchases, different things to try and lower long-term interest rates. They don't directly hold forward guidance, like tell you all to start spending. That was interesting. But one of the things that we've seen in the recovery is asset prices recovered, right? So you saw both house prices, and as Karen said, if you lost your house, well, it doesn't really matter that house prices are going, and actually it's probably bad for you if you're trying to get back in and buy. So those households many households didn't see the recovery in house prices, and there's a lot of households that did not benefit from the increase in asset prices, whether they're in the stock market or privately held assets. And that was one of the things with these distributional financial accounts that look at wealth. Middle income households, and this we worked on a speech Governor Brainerd gave in May. Middle income is like 70th percentile and below. Their wealth has not recovered in aggregate from the Great Recession. Like And it was just like the end of last year, it was getting really close, but it hadn't recovered. Everybody above that, especially if you look up at the top 10%, it's up a lot, right? So, I mean, not like it's up 20% or something, but that's a big difference. And this is years into the recovery. And a lot of that's related to, and this again is not just unconventional policy doing this, but just in this recovery, what you've seen is these asset prices increase, and that just didn't apply to a lot of people directly. I mean, there's all kinds of indirect effects from the economy being in a better place. So that's, and I think there's a lot of researchers trying to figure out what are these transmission channels. They may be different now given the tools we have. It sure looks like we'll probably be using some unconventional policy when the next recession comes. So there's that piece, and I think that's a challenge for the Fed, not just to know how to combat the recession, but for us to really understand how different households are affected when they do something that's very broad brush. So there's that. I do think, the reason I think the automatic is important is you just get it out the door faster. And with recessions, and I think one of the reasons the Great Recession, like the recovery was slow, it was great in terms of the shocks. I mean, what actually happened early in the recession with the financial crisis, and like that was big. Like that was a big hole that households had to come out of, businesses had to come out of. And as I said, some of them haven't yet. So the idea of the automatic is to get it out fast. My proposal is to get out a lot, like $100 billion a lot, like that's, and what that potentially can do is make this recession less severe. I mean, it would have taken a whole lot more than $100 billion to do, and I mean, there was stimulus that went out in that regard. Christy Romer was right, we needed more. Anyway, but like, that was a big hole, but in a more like garden variety recession, if you can get in there quickly, you could at least soften the blow. And that's part of the piece of the automatic, is it's just you can push it out fast, you can maybe make it a little less severe, and that's not just about the recession in the moment. We know that recessions have long-lasting negative effects. And so it can like kind of do on both sides.
Can I do 30 seconds on the,
Absolutely.
On the automatic question? I mean, I agree with everything Claudia said, but this touches on some of the research I'm trying to do right now, which is the automatic stabilizers are really important, and it would be great to put more in place. We know discretionary policy is also going to be an important part of the response to the next recession. And what we need to be, what the research community needs to be doing, and this is part of what I'm doing in my own research, is just thinking through, what kind of numbers will be involved, for a given increase in the unemployment rate, where to best target it, with the idea of just trying to socialize these ideas now. Claudia's right.
Do you have any numbers that you could preview for us? Not yet, okay.
That's been a couple months. But, when Congress sits down to kind of write the discretionary spending, what they need is some sort of blueprint. Well, first of all, we don't want them suffering from sticker shock, which was wrong in the last recession, but they need some kind of blueprint to go off of, because the discretionary stuff is slower than the automatic stuff.
I want to take a couple of questions from the iPad. And one is on full employment. Obviously, the jobs report came out today. Unemployment rate at 3.6%. Neil Kashkari tweeted and said, we're still not at full employment. This can go to both of you guys, which is, what is the potential of full employment to close these gaps in income and in wealth? If we reach full employment, will it finally happen?
I mean, certainly, I think it's been pretty well accepted that one of the benefits of this we have a hot economy, and one of the benefits is that we are seeing stronger wage growth, particularly for people in the lower part of the income distribution. It's entirely what you would expect with an unemployment rate of around 3.5%. So that's been a kind of just really nice kind of byproduct of the hot economy. I will say, to agree with President Kashkari, who would have thought we could be at 3.5% unemployment? And we saw wage growth pick up a bit, but it hit about 3% 9-12 months ago, and it's kind of just leveled out there. So we're not kind of seeing this kind of elevated wage pressures, which kind of suggests that that there's more slack there.
So to bring another data point to this, and I'm going to be a walking advertisement for the shed today. So one of the things that we did, and we can do this in a survey we have a lot of discretion over what we ask in this survey. So we said, okay, the populations we focus on, and the way we talk about the report are these low and moderate income individuals. Their work experiences are really different than any of our work experiences up here because many of them have jobs where they don't have control over the hours. They maybe are working in informal sector and gig economy, like making ends meet, because again, they have thin financial buffers, so you figure out a way to make it work. So this last year, in 2018, we said, okay, we're gonna step back from these official statistics that are like, are you in the labor force and da-da-da. So we just asked people, are you working or not? Okay, straightforward, yes, no. If you're not working, do you wanna work? If you are working, do you want to work more? Okay, real simple, 4 buckets. 1 in 10 adults told us they weren't working and they wanted to work. Okay, we had to really do some digging before we put that in the report because they're like, that's higher than the unemployment rate. Okay, yes, it is. So in other parts of the survey, we asked people if they had sent in a job application in the last year. So that's really what explains the difference. About half of that group hadn't applied for a job. So they're not out there, but they want to, okay? And actually unpacking that one a little bit more, because this really, that conceptually is where people start on full employment. So then we ask them why. Why aren't you working? Do you want to? A health limitation was a big piece of that. And that, like conceptually, in the official surveys, if they ask you, could you work? And if, like a physical impairment issue, and if you say, no, I can't physically work, you're just out. Like they're not gonna even ask you, like you don't show up in any more of the statistics because you can't work. Okay, but like health is not, you just get stamped with something forever. So there's this issue of like just thinking about what do we mean by people who wanna be working? Because conceptually that's full employment. Like if you wanna work, you can get work. The other thing, and I'll be real quick because that little timer's going down. 2 in 10 adults were working and told us they wanted to work more. So this idea of underemployment is important too. And again, like there's a lot going on in that. So add that up, that's 3 in 10 adults. So we've got work to do. I don't want to say that that's full employment. The Fed has never been able to come up with a definition of full employment. But that's part of their mandate. So I think, and this was information that we presented to that audience. I think it's just other data, and we need to think about some of these other issues in the labor market.
I'm going to try to sneak in one final question from the audience because it's a really good one, and I'm just going to read it because it was phrased very well. It says, no doubt that we're in a better place than we were in 2012, but our decade-long recoveries, where it takes 10 plus years to get close to where we were before a recession, is that going to be the new normal, and is rising inequality partly to blame?
I'll let you take this one, Karen.
You want me? Long recovery, lots of inequality. Are these connected?
Well, I think part of the reason the recovery's been so long is because we fell into such a deep hole, and deep holes always take longer to climb out of. But yeah, no, I think rising inequality has been part of the story because, for the reasons I talked about earlier, it's just made it harder to kind of use our usual tools like monetary policy to kind of restore health to the economy, not only in the United States, but globally.
But I guess given where we are now, given where income inequality is now, does that mean that the recovery from the next recession, even if it's not as severe as the one that we just experienced, is it going to take longer to get back to normal?
So I don't think that has to be the case. Like if we don't do anything, like that could happen, right? So I think one of the things that shows, and the Great Recession wasn't the only, we had a jobless recovery from 2001. So this pattern, and we've also had inequality rising for a long time. Not that that's causal, proves anything. Seems plausible. But that, to me, a lesson of that is like monetary policy cannot do this alone. And so that's just not a space. It can stabilize, but it can't address, or it has very weak tools to address income inequality or wealth inequality, any kind of inequality. So that means that we need fiscal. We need governments at all levels kind of thinking about how do we get at some of these root causes, whether it's and this goes really micro, right? Student loans, helping businesses get started. There's all kinds of ways to think about that bottom of the income distribution and how can we help them. So there's that on the government side. But I also think it's really important that the private sector thinks about this too. When I talked about these variable work schedules, there's some really interesting research that said, oh, employers do this because of the efficiencies. And there's research, I saw it at Equitable Growth, where basically the front office is not efficient and they do weird things. And that's why they need people to come in at strange hours. So there are things where the private sector could understand productivity growth helps. There are so many ways that the inequality causes problems in the economy, to firms, to business, to governments. So I just think this is one where if we don't do anything, if we just say, let the Fed take care of it, it's not going to change. And I think, to the question, there's no reason to expect it to get better just because it will. So.
Right. Claudia, Karen, thank you very much for a lively discussion. I'm sure we're going to talk about this beyond 2020.